Keep making it rain. This is Matthew Struck with Treadstone Risk Management. This is day 14 of our 30 Days of Insurance and Risk Management vlog. Today we are talking about limiting business interruption losses. So the title that we picked was Keep Making It Rain Even After a Loss. If anyone is unfamiliar with business interruption coverage is typically something that's built into your property policy, and it is focused on making you whole or as close to whole as possible when the revenue that your business normally generates, and actually net revenue that your business normally generates, is endangered or stopped by a covered loss. So as you can imagine, with property claims, that takes many forms of whether your building is damaged or if a big storm hits or something like that. You're not doing business. That means money's not coming in the front door. You might still have expenses as well that are happening on the back end, and so this coverage really kind of fills in that gap for you. So the one thing I'm going to start off with telling you is that for the vast majority of businesses, the threat to interrupting your revenue stream, or say for a nonprofit organization or any organization, the threat to that incoming revenue or incoming monetary stream being halted is the biggest threat to the existence of that entity, of that organization or business. And so business interruption coverage is extremely important. In fact, in a lot of cases, like a large catastrophic property loss, the overwhelming majority of the total loss, the total dollars that it cost, was from the business interruption piece and not necessarily from the actual physical damage to the structures or the buildings themselves. All right, we're going to start talking about the potential causes of a business interruption loss. The first of which is catastrophic property damage. So a big fire, big storm, something along that line, knocks your building out of commission, or knocks a lot of the property and the transit and the infrastructure around your building out. That can interrupt the flow of business that you're doing. A service supplier or a actual goods supplier or raw material supplier might have a property loss or some kind of interruption in their ability to do business, which then impacts your business. So with Superstorm Sandy, a big portion of the losses happened as a result of the loss of electricity. And unfortunately, there were a lot of people that didn't have coverage for off-site power interruption, meaning if the insured, if the business owner or the organization didn't have coverage for not themselves losing power because their building was damaged, but say their building wasn't damaged at all, but the power company went down and couldn't supply them with electricity, they didn't have any coverage for certain property coverages like spoilage or the downtime, or maybe a power surge and knocked out some of their equipment, their electronic data processing equipment. But also they didn't have any coverage for a loss of business interruption coverage, for a loss of business revenues, because their actual facility wasn't damaged. It was the utility that was damaged and couldn't supply the electricity. So that's actually a property coverage or a BI coverage that needs to be included in your property policy if you could be hurt by losing electric or water or another utility coming in. Or you could be hurt by a supplier of raw materials that you are dependent upon, and that can cause your processes, your business operations, to stall or halt completely. All right, acts of terrorism, civil unrest, war, that kind of thing, some of them won't be covered. So certain acts of war won't be covered under the standard insurance policy. It's blanket excluded. In most cases, you can't remove that exclusion. But things like terrorism or civil unrest or civil authority, meaning when the police or other law enforcement agencies come in and have to take certain action, shut down roads, shut down access, uh, you know, basically declare a curfew so that people can't go out after a certain hour. All of those things can be insured for, and you need to include those in your risk management planning. A cyber attack. So outside of traditional property insurance, the other big type of insurance policy that includes business interruption or business income coverage would be a cyber policy. Because as you can imagine, if you're very much dependent on your network or on the computers that you use on a day-to-day basis, and those are attacked and they're not available or you're locked out of them, you're going to need some kind of coverage to help you, because you would have been making money had it not been for that cyber attack. So cyber insurance actually includes, in most cases, business interruption coverage. All right, and then key employee injury or loss. So a lot of people think about this in terms of the life insurance aspect of it, but there are some other pieces to this that we'll kind of touch on in the near future. All right, we're going to talk about some of the best practices in terms of risk managing business interruption losses. The first of which is developing a business continuity plan. So a business continuity plan is going to outline certain scenarios, kind of broad or general scenarios that might occur, and kind of create some action steps and a chain of communication and a couple of other elements that help you kind of get through it. All right, they're going to focus on the preparation before the event, if you have that luxury, the action steps that need to be taken during the event, and then what needs to be done after the event to try and get up and running and back to full capacity, or as close as possible, as quickly as possible. All right, make certain that your property, flood, and cyber liability policies include business interruption coverage, and we kind of touched upon that before. Review your business interruption coverage limit every single year, okay, and complete a business income worksheet. All right, and so the worksheet can be a standard template that comes from elsewhere. Sometimes your insurance company will have one that they could provide to you, and what that worksheet is going to give you an idea of is what your exposure is, okay, and it's going to ask you, what your anticipated revenues are, what your anticipated expenses are, both fixed and variable. And then it's also going to ask you about certain types of, high volume times or high risk times where you might do more revenue during a certain period of year than other periods of the year. All right, and then the last thing is identify key components of your production or your operation. So key components could be a key material or input that has to happen. They could be a key business partner that you collaboratively sell with or co-brand. It could be a utility provider like we discussed before. And another one that a lot of people forget about is in a lot of business areas or commercial areas, you have some keystone residents or tenants that are the big draw, and your business might benefit from them being open. Well, if they're closed and they're out of commission, what does that do to your traffic and your customer flow? Could cut down on it dramatically, so you need to plan for that accordingly. All right, so some steps that you can take are identifying alternative locations or alternative methods or ways for conducting your business. So obviously, if your current location is compromised, can you move to a new location? Can you defer certain contracts to another provider? They might take a piece, but at the very least you're making something as opposed to just being completely down and out. Think about diversifying your supply chain. So instead of one supplier for a certain component or all of your components or all of your goods or raw materials, diversify, have 2 or 3. And that way, if you have a big interruption with your one main supplier, you can always arrange for alternative supply contracts with the other ones that are in the system, And if you're sending them a little bit of business every single year, they're already online, and it's easy enough just to kind of ramp up the amount that they're bringing you or the amount that they're doing for you. The other thing I'm going to talk about is in terms of vetting your suppliers and your other business partners. There have actually been a lot of business interruption losses that resulted from things that didn't have to do with the actual organization or business that suffered the loss. There was actually controversy that was associated with, and the one example comes to mind of Chipotle, and they made certain statements about the quality and the type of meat. I believe it was their pork products that they were providing, and the supplier that they hadn't properly vetted. And it turned out that the supplier was actually, I believe it was antibiotics, using antibiotics with the meat, and they hadn't properly vetted them. And so that PR hit actually hurt them financially. And so you need to vet your suppliers to make sure, one, that they're giving you the correct kind and quality of the product that you need or the service that you need. You also need to vet them from a cultural or an image standpoint, right, or a business culture standpoint, to make sure that you're not doing business with someone who completely clashes with the culture or the brand that you're building. And then the last thing that you need to think about is in terms of cyber liability insurance. If you have another provider that you kind of allow onto your computer systems and whatnot, you have to vet their security protocols to make sure that they're not going to inadvertently allow a cyber attack that could come in and interrupt your business and stop you from being able to make money. We're going to touch upon that again in the cyber risk management module that's later on in this series. Something else I'm going to tell you about is trade credit insurance. We touched upon it in the What Insurance Should I Buy module that was really early on in this series. Trade credit insurance, again, is basically accounts receivable insurance. Okay, so it's going to insure those products or goods that you sell on account to others, or you basically do a lot of work for someone and they run up a bill and you haven't gotten paid for it yet. Accounts receivable insurance makes sure that if that other party can't pay for any given reason, the insurance will at least pay you a portion of what's owed you, and then go back after that other party to try and recoup the money and make you whole. All right, again, from day 3, remember the concepts of duplication and separation, all right, when we talked about loss drivers. So a second set of equipment, a second location, it increased your overhead cost, but you always have to remember that you're looking at the lifetime health of your organization or your company, right, or your business. So that increased overhead cost might be worthwhile if it means that running 2 locations, one goes down, the one that's still up and running can soak up the extra production that's needed or the extra work that's needed in order to keep you whole or as close to whole as possible while you're fixing the first location. All right, for smaller businesses, identify larger businesses that are nearby that might complement your business or act as a traffic magnet. Like we talked about before, if you have a large retailer that's nearby, that's the reason why you get a lot of your foot traffic and a lot of your customer flow. You need to make sure to identify them and have some planning in place that, if they go down and if they're not there or they move and you're kind of left out on an island, what are you going to do? Are you going to change your marketing plan? Are you going to move yourself? That all needs to be taken into account. When you go through and you develop these plans and these contingency plans, include your insurance and risk management professional, because there might also be insurance considerations, right? The price of your insurance could change, the types of insurance that you're going to need could change, and so you need to include them in the conversation, and they're also going to be able to give you some ideas in terms of some alternative solutions that you might be able to think about in terms of your continuity planning. All right, and then for the last thing, for nonprofits and social support organizations, identify key donors and funnels or sources of money okay? Because a lot of nonprofits end up going under because they might be reliant upon one or two key donors that eventually decide that they don't want to donate anymore, or they run aground of something that those donors take issue with, and that's why those donors end up withholding funds, and in that case it could spell death for that organization, and you wouldn't be able to help your key stakeholders or the folks or the community that you're trying to help. So identify them and develop a contingency. If tomorrow their money wasn't coming in the door, what would we do? Okay? So that's all I really have on business interruption. It's actually a very complex topic. There's a lot that can be done. I wanted to keep the conversation very kind of high level and not really get too far down into the nitty gritty. But have a conversation with your insurance and risk management professional. If you have any questions or anything like that, please ask me, ask us, comment, and again, like the video, share it, subscribe, whether or not you're seeing this on the blog or if you're seeing this on YouTube, and we're gonna keep pushing these things out for you. See you next day.